John Boik, Lessons from the Greatest Stock Traders of All Time. Embark on an engaging journey into the thrilling world of stock trading through the book, Lessons from the Greatest Stock Traders of All Time, by John Boik. This summary gives you an intimate view of the impressive careers of 5 distinguished traders: Jesse Livermore, Bernard Baruch, Gerald Loeb, Nicholas Darvas, and Bill O'Neill, who have meticulously honed their skills to conquer the stock market. Delve into essential trading strategies, such as pyramiding, probing, and focusing on market trends, while understanding the significance of a strong work ethic and independent decision-making. Each of these experts offers invaluable insights into maximizing profits, minimizing losses, and navigating the challenges of the stock market.
Jesse Livermore, the legendary stock trader. Jesse Livermore, born in poor family in 1877, used his natural talent for mathematics to excel in the stock market. He began trading at the bucket shops by the age of 16 and became so successful that he had to move to New York after being banned from Boston bucket shops. Throughout his career, Jesse experienced highs and lows, accumulating and losing his fortune several times. Despite his success, he struggled with depression and ultimately committed suicide just after publishing his book, How to Trade in Stocks. Jesse formulated his set of trading rules based on his extensive analysis of his trades, such as the pyramiding and probing strategies. He attributed his success to discipline, relying on his own judgment and experience, and doing his own research instead of relying on tips and advice from others. From office boy to millionaire, the story of Bernard Baruch. Bernard Baruch, born in 1870, experienced unprofitable years in his early Wall Street career until he learned not to trade beyond his means and to be patient. At 25, he became a partner in his brokerage firm, and by 33, he was a millionaire. Baruch believed that the stock market was a gauge that revealed the economy's temperature and that the market's results were determined by the psychology of its traders. Keeping his emotions out of his trades gave him an advantage, and his commitment to extensive research about the companies he purchased stocks in strengthened this edge. Baruch pioneered the fundamentalist trading strategy and probed 3 facets of a company: its assets, product, and management. He actively traded until the 1930s, even serving under President Woodrow Wilson during World War I. Despite his wealth, Baruch spent many years in public service and donated large sums to charity later in life. He lived to 94 and died a happy, satisfied man. The Unconventional Investment Strategies of Gerald Loeb. Gerald Loeb, an investor born in 1899, had a successful investment career, but it was not without its ups and downs. Despite making vast investment losses early in his career, Loeb remained vigilant and adapted his trading strategy to become a successful investor. He believed that the stock market was a battlefield and that traders should study strategy, remain disciplined, and accumulate combat experience. In his book, The Battle for Investment Survival, Loeb argued that traders should concentrate their holdings instead of diversifying their portfolios. He favored an aggressive trading approach for high returns and advised traders to react quickly to changing market conditions. Despite the contrary view to traditional investing methods, his 1935 book is still considered a vital resource for investors. Loeb worked for E.F. Hutton and Company his entire career, becoming vice chairman in 1962. With a trading career that spanned 5 decades, he was an inspiration and mentor to many investors. Achieving success in trading. Nicholas Darvas was a professional dancer who made a fortune in stock trading by combining technical analysis with fundamental research. He developed the box theory, where he identified patterns in stocks' price fluctuations to create boxes. When a stock broke out of a box, he bought it and sold it at a profit. Despite his lack of experience in investing, Darvas made $2 million in 7 years, thanks to perseverance, patience, and full-time devotion to trading and research. His approach was a combination of research into a company's management and earnings and chart watching, which he called the techno-fundamentalist approach. Darvas assigned less weight to a company's fundamentals than to price movement and volume, therefore, his investment decisions relied mainly on chart trends. The book, How I Made $2 Million in the Stock Market, describes Darvas's successful trading strategy and offers valuable insights into how anyone can succeed in the stock market with a disciplined and patient approach to trading. O'Neill's trading strategy. Bill O'Neill's remarkable journey from a $500 investment to a self-made millionaire and creator of a successful investment strategy, Can Slim, is outlined in this summary. Bill O'Neill's successful journey in the stock market began in 1958 when he took a job as a stockbroker with Hayden, Stone and Company. O'Neill started trading with his $500 savings and achieved double-digit returns every year. His dedication led him to establish William O'Neill & Co., where he provided unbiased stock market research to investors. O'Neill's most significant contribution to the investment world came in 1984 with the launch of Investors Business Daily. The daily's circulation grew from 15,000 to 800,000, helping investors make informed decisions. O'Neill has written 3 books on the stock market, including How to Make Money in Stocks, The Successful Investor, and 24 Essential Lessons for Investment Success. O'Neill invented Can Slim as the result of his meticulous research and disciplined approach to trading. It is an easily remembered acronym that highlights 7 essential characteristics of a stock that is on the rise: current quarter, annual earnings, new factors, supply and demand, leader or laggard, institutional sponsorship, and market direction. This strategy has proved successful for many investors, and O'Neill encourages investors to analyze their trades and learn from their mistakes. O'Neill's belief in providing reliable information to all investors led him to establish 2 companies, and he has maintained his stance on avoiding recommending specific stocks. O'Neill's unwavering commitment to meticulous research and rigorous discipline has been the trademark of his trading style, and his contribution to the investment world is immeasurable. Unconventional tactics of successful traders. Discover the innovative strategies of successful traders who beat the market and learn how to apply them to your investments. In the book, the author shares the tactics of 5 traders who outperformed the market. These traders were not conventional and their strategies go against traditional advice. However, they had certain principles in common. One of these was establishing a cash reserve as a cushion, which they used to ensure that subsequent trades would not wipe them out. Another shared principle was to cut losses by selling losing stocks before losses reached a certain level, such as 10% of the trade. These traders believed in buying high and selling higher, instead of buying low and selling high. This insight was the key to Livermore's pyramiding strategy, and the other traders similarly increased long positions when stocks reached new highs, instead of selling and taking profits. They also agreed that sometimes it is better to be out of the market, although they had different ideas about what those times were. O'Neill, Darvas, and Loeb usually stayed out of bear markets, while Livermore avoided flat or sideways markets. Finally, instead of diversifying, they chose to concentrate their holdings after careful research and choose only the best-performing stocks. They also emphasized the importance of watching volume and price, which matters more than other numbers like P/E ratios. The tactics of these successful traders are sure to help any investor looking to improve their returns and beat the market. Successful trading strategies. Successful traders follow personal rules along with trading rules. These rules include analyzing every trade, devoting full time to studying and trading, performing independent analysis, and making decisions based on facts. Emotions and ego have no place in the stock market. These traders referred to their strategy as speculation, and accepted losses as part of the process, while letting winners ride. Risk creates upside potential in trading, and it is essential to leave your ego behind when trading.
Having explored the careers and strategies of these remarkable stock traders, it's clear that the key to success in the stock market lies in rigorous discipline, analytical understanding, and unwavering persistence. The shared tactics among these exceptional individuals include establishing robust cash reserves, cutting losses, concentrating on the best-performing stocks, and maintaining an unyielding dedication to their craft. Furthermore, they demonstrated the ability to make independent decisions, remain knowledgeable about market trends, and stay observant of price and volume changes. By implementing these hard-earned lessons, you too can navigate the exciting world of stock trading and potentially emerge victorious.